You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Ever feel like the world's moving at, warp speed? And keeping up with all the global shifts feels like a full-time job.
Yeah, absolutely.
Navigating these currents, global markets, trade, geopolitics, it can feel like trying to catch a wave that just keeps changing shape. Well, consider this your essential compass, your way to stay genuinely well-informed. Today, we're doing a deep dive into your latest briefing.
Right.
We're aiming to uncover the critical insights hiding behind the headlines, moving past the surface to really understand the forces at play.
Exactly.
We're talking everything from subtle currency shifts and what's really driving commodity prices to the complex trade deals and, the shifting ground of international relations. What's crucial here, I think, is grasping just how deeply interconnected these areas are.
Definitely.
You see a seemingly small tweak in one financial market, and it can send these unexpected ripples right through global trade and geopolitical events. They very often provide the real foundation for broader economic trends.
So our mission today is really to help you decipher not just what's happening in your sources, but why it matters for the bigger picture. We want to give you those sharp aha moments,
Yeah, the ones that make information stick.
Exactly. Turning raw data into, genuine understanding.
Okay, let's get into it then. Let's unpack this. Starting with the currency markets. Things are definitely not static there.
Far from it.
Your sources show the dollar index is still, stubbornly choppy. It actually softened yesterday, which is interesting despite what looked like good domestic news.
Yeah, that was surprising.
We saw U.S. GDP revised higher, jobless claims sell. Pretty positive stuff, right?
Right, but the market reaction.
Exactly. Traders are clearly being very cautious, treading carefully ahead of today's personal consumption expenditures release the PCE inflation data.
Which the Fed watches like a hawk.
Precisely. And Fed Governor Cook's hearing is also coming up. And speaking of the Fed, Christopher Waller, he's a prominent voice, he reaffirmed what's being called his dovish stance, specifically supported a 25 basis point cut in September.
And even hinted at more easing down the line, didn't he?
Yeah, over the next 3 to 6 months.
What's truly insightful here is how the market seems to be almost ignoring those positive U.S. numbers. It's prioritizing future Fed moves and inflation signals above, pretty much everything else. Waller's comments, they aren't just the signal.
No.
They're kind of a testament to the Fed's huge psychological influence, It shows how forward guidance can, sometimes at least, outweigh the current fundamentals.
It almost feels like the market's hooked on anticipating what the Fed will do next.
You could say that. It's a delicate balance, right?
Yeah.
And the market clearly believes the Fed's view on inflation and policy is, more powerful than today's growth figures.
That's a really critical point about market psychology. And that tension, it plays out differently elsewhere, too, doesn't it?
Absolutely.
If we shift from the U.S. to Europe, we see similar economic pressures, but with distinct local factors hitting the euro and sterling.
Right.
The euro, for example, it eased off Thursday's highs, hit resistance near 1.1777.
And that wasn't random.
No, it was largely down to some pretty disappointing German retail sales figures, points to weakness in the Eurozone's engine, right?
And French inflation was soft, too.
Yeah. Undershot expectations, suggests maybe a broader disinflationary trend over there.
Meanwhile, across the channel,
sterling slipped below 1.3500, and that weakness felt like a mix of things.
Definitely a cocktail, yeah.
You've got ongoing political uncertainty, leadership whispers, Brexit echoes, maybe.
Could be. Plus, cabinet reshuffle talk always makes markets nervous.
And then, perhaps the sharpest hit, recommendations for a windfall tax onto commercial banks.
Oof, yeah. That could really bite into bank profits and investment if it happens. A big headwind for the UK economy.
For sure.
Indeed. The knock-on effects are significant. So you've mentioned the euro and sterling struggling, and then there's the Japanese yen. It seems pretty directionless.
Stuck in limbo.
Yeah, caught in this tug of war after mixed Japanese data. You had weaker industrial production, weaker retail sales.
Suggesting headwinds.
But then unemployment actually improved unexpectedly. So conflicting signals make it hard for traders to pick a direction.
Makes sense.
But while all this is happening, there's this quiet strength emerging in the antipodean currencies.
Ah, the Aussie and the Kiwi dollars?
Exactly. They continue to find support.
That is an interesting divergence. What's propping them up when other majors are, having a tougher time?
A key factor here seems to be another stronger yuan fixing from the People's Bank of China.
Okay, explain that a bit for us.
So the PBoC sets a daily reference rate for the yuan. A stronger fixing often signals confidence, or maybe it's a policy choice to manage stability.
Right.
In this case, the midpoint was set at 7.1030, stronger than the expected 7.1274.
And that helps the Aussie and Kiwi be kind
So
of...
for the close trade ties. A stronger yuan suggests stronger Chinese demand, which is great news for Australia and New Zealand's export-heavy economies.
Ah, I see. Connects back to China's economy.
Exactly. So if we connect this to the bigger picture, you really see how domestic data, politics, and even like strategic moves by another major economy like China, it all weaves together this complex, interconnected web influencing global currencies.
It's rarely just one thing, is it?
Almost never. It's a convergence of forces.
Those ripple effects really are everywhere. Okay, let's shift focus now. From the abstract world of currencies to the physical stuff, commodities. The things that fuel our world, build our futures.
The tangible assets.
Crude oil, always a big one. It's currently steady, but sort of consolidating after picking up on Thursday.
Taking a breather.
Brent crude is just over 68 ounce a barrel. WTI near 64 worries. Those earlier gains were mostly about positive demand outlook, maybe some supply worries. But now the market's just, catching its breath.
Waiting for the next cue.
Exactly. Then there's gold, often seen as the ultimate safe haven.
The classic hedge.
It's faded a bit from recent highs above $3,400 an ounce. And traders here seem to be waiting, almost on pins and needles.
For that U.S. inflation data we talked about.
Yeah, before making their next big move.
Gold's movement is fascinating, isn't it? It's so tightly linked to inflation expectations, but also real interest rates.
How so?
Well, when inflation uncertainty is high, gold tends to do well as a store of value. But if that inflation data comes in surprisingly low, or if real interest rates climb...
the opportunity cost of holding gold goes up.
Precisely. Holding a non-yielding asset like gold becomes less attractive, pushing prices down. The fact it's just hovering below its peak, waiting for that inflation number, it really underscores its role.
As a hedge against instability.
Yeah, economic instability, currency devaluation. It tells us the market is still deeply uncertain about where global prices are heading.
So gold's holding its breath. But copper, kind of the industrial workhorse.
The bellwether metal.
It seems to be marching to a slightly different beat. It continues to trade in a pretty firm range. And the mood around Chinese demand seems quite positive.
Yeah, and that positive tone for copper, it's a direct result of those recent liquidity injections from Beijing we mentioned earlier. The stimulus money.
Exactly. China's central bank, the government, they've been pumping money into their economy, stimulating growth, ensuring stability.
Right.
And that increased liquidity means more funds available for infrastructure, manufacturing, construction.
All things that need a lot of copper.
Loads of it. And this raises an important point about global economic health, doesn't it?
How so?
China's demand for metals like copper is often seen as a leading indicator, a bellwether for global manufacturing and growth.
So strong Chinese copper demand signals a healthier global outlook.
Generally, yes. It suggests those liquidity measures are having a real impact, even beyond China's borders.
That's crucial context for reading the global tea leaves. Okay, let's pivot again. Let's talk about the evolving global trade landscape. Always a tricky mix of diplomacy, economics, and sometimes sheer political strategy.
Always complex.
Starting up north with Canada, they've signaled they don't expect President Trump, if he returns to office, to remove all tariffs on their goods. That's a significant statement, isn't it? Almost preemptive, acknowledging that protectionism might stick around.
Yeah.
And it really highlights the long shadow that past trade policies cast. Even with potential new leaders, some issues just remain incredibly sticky.
So it's deeper than just who's in charge.
Seems like it. It points to maybe systemic challenges in trade relations, not just fleeting policy choices. Tariffs, once they're on, are notoriously hard to fully remove. They get tangled up with domestic industries, politics. It suggests that the era of, completely free and open trade, even between close allies, maybe that's giving way to something more managed, more strategically competitive.
That's a sobering thought about enduring complexities. So, with those issues in mind, what about new agreements happening elsewhere, further south?
Well, shifting focus, Brazil's Vice President Alckmin said talks with Mexico on a complementary trade deal should wrap up around mid-2026.
Mid-2026, that's a ways off.
It is. It reflects how detailed these bilateral deals are. But it shows a strategic push by two major Latin American economies to deepen ties.
Okay. And across the Pacific.
Japan's negotiator, Akazawa, confirmed he's heading to Washington once things are arranged. Might need more visits before a U.S. executive order on trade gets finalized.
So lots of negotiations still.
Definitely. But both these examples, Brazil, Mexico, and Japan, U.S., they point to a world that's constantly and often painstakingly renegotiating its economic relationships.
Bilaterally, regionally.
Right. These deals are fundamental for securing future economic interests, adapting to changing supply chains, navigating all these geopolitical shifts.
It's clear nations are constantly tweaking their partnerships. And speaking of tweaking, or maybe more like pivoting, India, a major developing economy.
Watch India closely.
They're proactively shifting their trade strategy, looking to build new ties with markets like Australia, and importantly, taking steps to boost their own domestic demand and support exporters who've been, quote, hit by unilateral measures.
Yeah, see, this isn't just simple diversification. It feels more like strategic de-risking.
De-risking.
Moving away from relying too heavily on maybe one or two major partners or supply chains. India's pivot signals that economic security and geopolitical alignment are becoming, really intertwined.
Building resilience.
Exactly. Creating maybe a more multipolar trade world where old dependencies are being questioned, maybe even dismantled. It reflects this growing global trend. Build resilience against shocks, against specific trade actions. Don't put all your eggs in one basket.
And for a really clear, almost pointed sign of ongoing trade tensions, let's talk soybeans.
The humble soybean. Often tells a big story.
Your sources note China has significantly stepped up soybean buying from Argentina and Uruguay.
Okay.
But here's the kicker. They are pointedly avoiding new U.S. soybean bookings for the fourth quarter.
Wow. Okay, that's not subtle.
Not at all.
That specific action, it's a direct, unambiguous message, isn't it? Underscoring those ongoing trade tensions with Washington.
Definitely feels like it.
It's not just an economic choice about where to buy beans. It shows how trade has become this powerful tool, economic and geopolitical.
Using market access as leverage.
Precisely. By deliberately shifting purchases away from the U.S., China's signaling displeasure, exerting economic pressure, using its huge market demand as leverage in the bigger picture. It's a textbook example of trade being used in diplomatic disputes.
A really stark illustration of commerce and statecraft mixing.
Okay, finally, let's delve into the really complex, often tense world of geopolitics, where words and actions have global ripple effects, often way beyond their immediate area.
High-stakes arena.
On the Iran nuclear deal front, Iran's foreign minister firmly rejected European efforts to reimpose nuclear-related sanctions.
The E3 nations, France, Germany, UK.
Right. Iran argued they lack the legal jurisdiction. He did say Tehran is willing to return to talks.
But only if the other side acts in good faith.
Exactly. A big condition.
What's especially compelling here isn't just Iran's defiant position, it's the immediate backup it got.
From who? Russia and China. They quickly echoed Iran, stating publicly the UN Security Council has no legal grounds to act on those European proposals.
Wow. Unified front there.
Absolutely. That alignment is incredibly significant. It signals a united stance from two major global powers, directly challenging the legal authority, the diplomatic push of Western nations.
That sign of evolving power blocks.
And maybe a fracturing of consensus on how international rules get enforced. Definitely shows shifting dynamics.
Absolutely. Okay, moving to Eastern Europe. Reports say European leaders are weighing the idea of a buffer zone between Russian and Ukrainian lines.
That's part of a potential peace framework.
Yeah. Sounds pragmatic on the surface, but it's clearly far from simple, right?
Oh, anything but simple. Officials are reportedly deeply divided on just the practicalities.
Like how wide it would be, who polices it.
Exactly. How would it actually work? And crucially, it's highly uncertain if Kyiv would even accept terms that involve giving up territory.
Which a buffer zone almost certainly implies.
Almost inevitably. So it raises these fundamental questions about the path to a lasting peace and the core security issues for everyone involved.
And Russia's view?
Well, Russia has already dismissed Western security ideas, seeing them as a sort of backdoor attempt to pull Ukraine into NATO's orbit.
And they warn that increases risk.
Yeah, it raises the risk of further, more direct conflict. So you see these deep, almost irreconcilable divides. Proposed solutions viewed through totally different lenses: national security, territory, history.
An immense challenge finding common ground there. Okay, one more hot spot, closer to the Americas. Venezuela. They recently launched a formal complaint at the UN about what they called a U.S. naval buildup in the Caribbean.
Right.
President Maduro later publicly insisted the U.S. cannot enter Venezuelan territory. And he also claimed, and this is key, direct backing from China, Russia, and India in resisting U.S. pressure.
That claim of backing is really interesting.
Yeah.
We connect this to the bigger picture.
Yeah.
This situation highlights the rapidly evolving dynamics of global power and influence. It's not just Caracas versus Washington.
No, it's broader.
It shows how countries like Venezuela are increasingly seeking and very publicly claiming support from diverse international blocs, especially those seen as rivals to the U.S.
To resist pressure.
Exactly. In resisting perceived external pressures, it signifies a move towards a more multipolar world order, where traditional alliances are being tested.
And new alignments forming.
Potentially. Forming around shared geopolitical goals, or maybe just shared opposition to existing powers. It's a strategic calculation by everyone involved, really, designed to boost their standing on the world stage.
So after covering all that ground, what does this all mean for you, trying to make sense of this complex global landscape?
It's a lot to take in.
It is. We've journeyed through those choppy FX waters, looked at what's driving key commodities, explored shifting trade strategies, touched on critical geopolitical flashpoints.
Across multiple continents.
The main takeaway, it seems clear. Everything is profoundly linked.
Absolutely interconnected.
From a central bank hinting at rate cuts affecting investment, to a country strategically buying soybeans, altering trade flows, or even a proposal for a buffer zone potentially changing a conflict's course.
Every piece tells a vital story about our interconnected world. And knowledge, as we always emphasize, is most valuable when it's not just passively received, but actively understood, applied.
Right.
These briefings, they're more than just headlines. Think of them as vital signs of global health, indicators of shifting power dynamics, crucial signals for anyone trying to navigate the world.
Absolutely. Okay, so here's something for you to mull over, reflecting on today's deep dive.
Go on.
Considering these trends we discussed, countries actively diversifying trade partners, seeking broader, maybe non-traditional international alliances. How might the traditional global economic and military blocs reshape themselves in the coming years?
That's a big question.
Will we see a more fragmented world? Or maybe new, unexpected coalitions emerging? Something to think about. Keep those critical thinking gears turning.
And stay curious.
And we'll see you on the next deep dive.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.